Good morning. I'm with Vince Lanci of GoldFix, and we are doing part one of our special edition focus on the miners, and specifically gold and silver miners. Definitely a bias towards gold because just that's the way the world is, and that's what's in the ground. Vince, hey, how you doing?
Good, Robert. Thanks for having me on.
My pleasure.
I get to pick your brain.
Yeah, well, we get to pick each other's brains. I think this will be a fun conversation, and there's a lot to get to. So before we get into the actual meat of today's content and get into the specifics on a number of mining companies, let's just sort of set the stage for what's going on in the world today. So obviously, like last week was a very volatile week across markets. The oil price, I mean, wow, what a move. I mean, like I recall Sunday night, it was gyrating. The WTI future for like 74, 75. It pulled back to 71. And then it just took off for the rest of the week. So crude actually closed above 90. And I opened up Barron's this morning. It's the front cover. And the feature article is why $100 oil is now in sight. Who wins, who loses, right? And so clearly now, gasoline prices are going to hit people this weekend. They're going to notice a difference, and they're going to notice a lot of chatter, a lot of headlines about oil. And so why I bring this up? Well, I think we should have a little chat about oil first, but also what is the relevance to the mining sector, the mining industry. And I guarantee you on X over the next few days, we're going to see a lot of people posting tweets about how, you know, maybe gold miners are short because the oil price, that's one of their major cost inputs. In order to mine gold, it takes diesel. You know, it's usually diesel, but let's just use the WTI price as a good proxy for those costs. But so I just want to make a point that this is a battle I've been fighting for a few years, and maybe back in like 2012, 2013, this was very true. That the crude oil price was a big cost input for the gold miners, the big ones, the Newmonts, the Barricks, the Agnicos. Less so today. And I'm going to give you a stat, and then we're just going to move on from this. Newmont, the world's largest gold producer, doesn't get bigger than Newmont, 7 million ounces a year approximately of gold production. They are already factored in for $70 WTI. Like that's their base case. It was under 60 not too long ago. Now we're at 90, right? So for every $10 above $70 WTI on an annualized basis, it's got to be like the average price for a year. That's an extra $60 million of cost for Newmont. So even at 100, if the WTI stays at 100 for a full year, it's an extra $180 million in cost for a company that generated $7.3 billion in free cash flow in 2025. So it's not that significant.
Now, why is that? Meaning, how far out the curve do they hedge their energy?
There's some hedging there, but also just frankly, it's not as energy intensive as everybody makes it out to be, right? So they're also using a lot of base load power, right? And so they're hooked into the grid. The basically their dependence on crude oil pricing is mainly just for their fleet of vehicles, right? And they've hedged a lot of that. And also just things like 70 to 100 is not even a 50% move, right? And yeah, I mean, it makes a difference. It obviously hurts. $180 million is not insignificant, but for a company the size of Newmont, they're pretty well sheltered. Now, I mean, if this thing gets totally unhinged and we're talking about 120, 130, 140, then obviously that becomes a bigger problem. But I think that's a bigger problem for the world and not just for the gold mining industry. So I can tell you that the fears and the negative talk about the gold mining sector and higher crude oil prices are largely overstated.
Yeah. Was that the data piece you wanted to share, or was there another one?
No, that's it. I mean, that's
The Newmont's cost goes up by only how much?
$60 million on an annualized basis for every $10 above $70 on the WTI crude price. But again, that's an average on an annualized basis.
Right.
Well,
Okay.
so like actually right now, if we just talk about 2026 and the average WTI price since January 1, well, I would assert the average price is probably under $70 a barrel. So this is not even a conversation. Obviously, it could become a conversation over the next couple of months. But as of now, this is not even worth talking about.
I would add a couple things to that. The first one is that I have seen in my subscribership an increase in concern about that or talk about that. But I think, and not to belittle it, but I think a lot of that is because miners over the years have been always waiting for the other negative shoe to drop, and so oil goes up, and there's always been an excuse to sell miners. I don't think those excuses exist anymore. Now, to put a little bit more meat on it, I know that companies that have energy risk, companies like big miners, companies like airlines, they don't hedge their risk in the spot market. So if I could just, I shared this with my people, I want to share it with you. This is the oil curve, right? Here's spot, and there's 1 year out. Most companies hedge for the year. So when the war starts, oil does this, right? To exaggerate, oil spot goes up. They don't care. They're out here. They're hedging out here, or they've already hedged out here. Now, if oil stays up here long enough, the oil dynamic goes like this. The whole curve starts to go up and the belly goes away again. So now your back end starts to go up. Now, that's the stagflationary situation. So we're here, we have a war, the war becomes chronic and the whole curve goes up. Well, at this point, you're in the stagflationary era, and this is where gold starts to rally. When when there's a war, oil goes like this, and gold sometimes goes up, sometimes doesn't, because the dollar gets in the way. But as the oil problem becomes chronic, as a veteran of 3 trading wars, as the oil problem becomes chronic, the whole curve rises like this, and that's stagflation, and where the back part of the curve stabilizes at $80 or $90 as opposed to 65 or 70, because right now the curve is doing this, and nobody cares about 1 year out. They only care about the next delivery. So I would add to your point that energy doesn't matter as much as people think it does, number one. And number two, what has mattered in the past as much as people think it does is that any excuse to sell miners would be used. But I don't think those excuses are going to work anymore. So I'm with you on that.
Yeah. Yeah, I just wanted to get ahead of what I know is going to be in the water here over the coming days.
Of course.
A couple other points before we get into the into the meat of it. First of all, I was thinking about this last night. Like, what is the average gold price in Q1? Because it's been all over the place. Like, remember we were like at 5,600 for a few hours, right? And then we were at 4,500, right? So I did a little research, and I was right. I figured the average price was right around 5,000 now. Well, it's like 5,050. So it's actually a little higher than I thought it was. And so why is that relevant? Well, it's relevant because the average realized selling price for the gold producers in Q4 was under 4,200 an ounce. It was like 4,150. So our average price so far in Q1 is $900 an ounce above where it was in Q4 2025. And Q4 2025, almost every producer made record profits and generated record free cash flow, right? So like with Newmont, it was above 2 billion. With Agnico, it was about 2 billion. And so, you could go down the food chain. They're spitting out a lot of free cash flow. And so when you talk about an extra $900 an ounce for a sector that right now The better companies average all-in, sustaining cost is around 1,400 to 1,500. So some are up around 1,650, but let's just say 1,500 as a ballpark number. So 5,000 is the selling price, 1,500 is the cost. That's a 70% margin there, and that's a significantly larger margin than it was in 2025 and even in Q4 2025. So the profits that the sector is looking at here, knock on wood, obviously the gold price can change, but the profits the sector is looking at here, based upon the average price in Q1 and where we went out on Friday, 51.70, are very, very large, right? And just look at the charts, like look at Barrick, look at Newmont, look at Kinross. Well, like for example, Barrick is trading where it was in December. Right, it went up, it went down, but basically it's gone sideways for the last 3 months. So the market is not really pricing in a big Q1. They're not pricing in.
It's definitely preoccupied with other problems right now.
Exactly.
Definitely preoccupied with that, and that's on top of the fact that miners still haven't grabbed the full attention of investors. I think that point's a valid point because you had mentioned it yesterday when we had a quick call, and I mentioned it to my subscribers today as well. I think it's a good point that the free cash flow, barring a catastrophe on the price of gold over the next 20 days, barring a catastrophe, this is going to be the best operating quarter of all time for these guys. I mean, I don't see how it could be I don't see how they've had any better. And last best operating quarter was last quarter. So I think we're at the beginning of a trend. And when you're looking at investors in terms of like when are miners going to catch up, when you're looking at investors, 1 time is an aberration, 2 times is a pattern, and 3 times is a trend. So the traders get in after the second time, or before the second time, I should say. And that's what I think we're looking at here. I think we're looking at a natural catalyst for these miners that I want to buy, and miners that I want to get your opinion on, as well as the big miners, which I'm going to add to that as well. I own the SILJ, I own the SIL Juniors, and I'm going to overweight a couple of them. But you wanted to
one more point, and then we're going to get into it.
You got to stay humble.
I got to stay humble. So basically, like my assertion based upon just, what I said here in the last 10 minutes or so is also that like there's not a huge amount of optimism baked into the gold mining sector right now at Friday's closing level. As I said, Barrick basically flat the last 2 or 3 months, despite the gold price going higher. But I also, on the very next breath, I want to acknowledge that a lot of money was made in 2025 in the gold and silver miners. In some cases, crazy money, right? Like I want to, acknowledge there were plenty of 10Xs, especially among the juniors. And so we cannot expect every year to be full of 10X, gainers. It's not the way the market does it. But on the very next breath after that, I'll say, yeah, 2025 was a great year. And I'm not necessarily saying that we should expect 2026 to be as good or better for the sector compared to 2025. But also, this sector went through a lot of really bad years. A lot. Like since 2012, like probably 80 to 85% of the years were pretty dismal with 20, 30% losses across the sector on average, right? Like 2022 was an abysmal year. 2023 was a dreadful year. Only in 2024 did things start to turn, and then only among the biggest and best companies did they really start to turn in 2024. So 2025 is actually the first year in a very long time that pretty much the entire sector worked well, right? Like if you
the breath kicked in 2025, and that hasn't happened in the past.
The breath kicked in a big way in 2025, and that was the first year since probably 2011 that the breath kicked in such a powerful way across the gold and silver mining sector.
And there we are waiting for the shoe to drop again.
Yeah, and so we're waiting for the shoe to drop. And look, hey, I'm a veteran, you're a veteran, been there, done that, made mistakes, lost money in miners plenty of times. So as soon as I'm getting on here talking bullish with you, I'm like, hey, I could be wrong. Like don't shoot me if I'm wrong. You know?
We have to be careful. Exactly.
Have to be
Exactly.
careful.
I mean, look, you can't be unhappy after last year.
No,
On the
a
mining side,
lot of money was made in 2025. A lot of money was made across the sector.
And we have, as people with a lot of scar tissue, we have no right to expect to have 2 years in a row like that. But we're preparing for it anyway because good things happen sometimes.
Good things happen sometimes, and trends trend for longer and farther than we could ever imagine, right? And so let's keep open the possibility that this trend has a lot farther to go.
Right, right. Okay, so I'm glad we did that. I don't want to come across as encouraging FOMO. I appreciate that. Well, should we get to the meat of it now?
Yeah, let's get to the meat of it. Yeah, I'm definitely
This is where I pick your brain. And I had been threatening among my subscribers to release a list of miners that I wanted to buy. Now, my background is I started as a fundamental analyst. So I do that work. I haven't done that work in a long time, and I have to do it again. But I saw a particular type of miner that I wanted to start buying. And essentially, it's a barbell trade. So I wanted to buy, at one end of the barbell, I wanted to buy the miners that would do the acquiring. And those miners would be the Newmonts and the Barricks. So that's your big ones, right? Those are the ones that would be acquiring the explorers or the juniors or the developers. And the other end, I want to look at. I haven't acquired any except for one, a particular type of junior, and it's a small to mid cap junior with single asset or few asset producers. It's a restart turnaround. It has high grade deposits, allegedly, a near term production ramp, and usually most of these are Canadian or tier 1 jurisdiction. So that's my broad criteria, and I put together a list. But before we get into the list, I'd like to hear your thoughts on those type of criteria for miners. Like what are the limitations or pluses on those?
Okay, so very interesting, and a lot of criteria there. And first, before we get into the specific companies, everybody wants high grade. I mean, like that's just, oh, of course I want high grade. Like, why would I want low grade, right?
Right.
But it's not just as simple as saying I want high grade, because it's never, the ore bodies and the operations are never that simple. So usually in the earth, when these gold deposits were formed, when Mother Nature injected a lot of gold into these veins to make high grade deposits,
right,
they did so over a limited area, and the tendency is for the veins to be relatively narrow. So instead of thinking about like, hey, I found a gold mine, it's a bathtub of gold. It's a bathtub of gold that extends for 1,000 meters in all directions. Although there are some gold deposits like that, those tend to be lower grade, what we would call bulk tonnage, deposits. So instead of thinking about like the average grade is 10 grams of gold per ton, 10 grams of gold per ton at today's prices, let's say $1,500 of pay dirt per ton of earth that you have to move. That's high grade. Like 10 grams per ton is high grade. It might be a half gram per ton in these quote unquote bathtub gold deposits, right? But
right,
all you need is just a lot of huge trucks and shovels to scoop up that dirt that has that half gram per ton pay dirt. And a half gram is $70 or $80 of pay dirt per ton, and your operating costs might be $10 or $15 or maybe $20 on the high end per ton. So your operating margins are still 75 or 80%. So there's lots of ways to have profitable mining operations. And usually with high grade, number one, you're talking about underground mining. So you're not talking about the bathtub of gold at surface. You're talking about narrow veins that are plunging deep into the earth. So you might have to go 5, 6, 7, 800 meters down. And again, the veins are narrow, so they might only be 1 meter wide. And you have to carefully follow these veins down into the earth. And hey, look, 10 grams per ton is worth it. You can still make a lot of money doing that. But it's not quite as easy as just like, hey, high grade, no brainer, right? Like, of course we want high grade. And like, also there's some nuance, Vince, in terms of what is quote unquote high grade. And now here in 2026, we got a lot of companies, everybody says they have high grade, right? So the company that has 0.9 grams per ton says we're high grade because they believe it's going to be an open pit deposit and the gold is close to surface. So in that context of a potential open pit,
it potentially qualifies. Right.
Yeah.
Right.
So
right.
yeah. So when the gold is at surface, 0.9 is really good. But when the gold is 600 meters deep into the earth, 0.9 is not good. It's not profitable 600 meters down. But 9 or 10 grams per ton gold, that's profitable 600 meters down.
Right.
So there's just a little nuance there. And then whenever it's a restart, whenever it's a mine that failed in the past, well, there's some skeletons.
It's the management.
It could be the ore body. It could be that the First Nations group in the area said we don't want mining. It could be a lot of things. You have to go into the nitty gritty, and this is the tricky part about mining is there's a lot of nitty gritty with some of these things, right? And so that's where somebody like me comes in, and not to say I know everything because I don't. There's so much to know in mining, but I know enough. And when I look at something for an hour, I can probably get you pretty close to the fatal flaw, and then it's up to you if you want to go further and actually dig deep, right?
Right. Well, that's the thing. I know that I'm going very narrow in my search, but that's because at the other end of the barbell, I'm very broad. So I'm going with the Newmonts and the Barricks at one end of my barbell, the acquirers, and I'm going with the acquirees at the other end of the barbell. And I think the acquirees are going to be companies that are mine restart stories, old infrastructure, a new gold price environment. High grade districts. Again, we have to be careful. Well, high grade districts. So, like for example, Red Lake historically produces like 30 million ounces of gold. West Red Lake, I should say.
Red Lake. No. It's called, Red Lake. West Red Lake is the company that's now operating there. But the whole gold camp is called Red Lake.
It's Red Lake, and and they're in West Red Lake. Yeah, I understand. Which, by the way, long story short, that's the one mine that I bought. So we're going to go through that mine and the other mines that I'm looking at. But by the way, I haven't progressed, just speaking to my people here and yours as well, I haven't progressed in my analysis anywhere near as far as I've gotten with West Red Lake. So these names are names that are on my list to be looked at. They haven't already been looked at, and they fit the criteria, small mid cap, single asset, restart, high grade deposits, in quotes, high grade deposits, near term production ramp, et cetera, et cetera, et cetera. And hopefully Canadian or American, but I think there's at least one of them there that's not. And we'll have to think about that. But I also want production ramp optionality. So like Madsen and West Red Lake could scale, I think, from roughly 45,000 ounces a year to much higher levels, depending. So that's a little bit of the work that I did do. And so that's why I'm familiar with them, familiar enough to say that I spent some money on it. But why don't we start with West Red Lake? Tell me what you think about them, good, bad, and indifferent.
Okay. So first of all, I had no idea you were going to say West Red Lake. We didn't talk about this, ahead of time. So I want to put out my disclosures. I'm a shareholder, and I've interviewed this management team a bunch of times, and the company has paid me for a couple of those interviews. So let's just put that out there. I am biased.
Let me add. I have no relationship with any mining company, and so this is completely on my impetus and my analysis. And I think there's going to be some. So this is a good coincidence. It's truly a
good coincidence. Yeah, because I know it really well, but also like, I want to put out there that people would say I'm probably biased, right? Look, so
but I'm not biased. I'm not biased, and my job is to. Well, I've already decided. I already bought the other 10 or 7 or 8 that I haven't bought yet, but they all are based on my analysis of West Red Lake. West Red Lake fit my criteria, and these other 8 are lined up with that criteria. So I'm biased because I bought. I'm not biased because of any other reason. So it's a coincidence that we're online with this.
Yeah. It's a coincidence, and I'm biased for the sake of stating those things up front, but I'm going to tell you like it is, right? I'm going to tell you like it is. So this is a story I followed since 2023, and what happened here, Frank Zustra, who's a Canadian mining billionaire, he basically purchased this asset, the Madsen mine in Red Lake, out of bankruptcy. So basically the prior operator was called Pure Gold. By the way, Pure Gold in the 2019-2021 cycle achieved $1 billion market cap with this asset, but they achieved $1 billion market cap before actually getting into production and proving that they could operate the mine. So, but that just shows you that at like a $1,800 gold price environment, this asset was perceived by the market as being $1 billion asset, right? So Pure Gold failed. They were not able to get enough ore through the mill to meet their costs. And when you're talking about ramping up, even this is a small mine, in the scale of, in the grand scheme of mines globally, this is a small mine. It's high grade, but it's a small mine, right? So the mill is like 800 tons per day, 1,000 tons per day. There's other mines in the world that are 10,000 tons per day or 30,000 tons per day. So this is small in the scheme of things, but it's high grade gold, and that's why it's a relatively small mill throughput. So anyway, Pure Gold failed, went into a bankruptcy process. I don't know all the dates, but 2022 is basically in the bankruptcy process. 2023, Frank Zustra's group wins the bid for the asset. Again, I don't know all the details of the financials, but they got it for pennies on the dollar, essentially, right? And then they had the hard work of, we got to ramp this thing up. We got to make this work, right? So there comes West Red Lake coming in as a public company at some point in late 23, early 24. And basically the last 3 years has been the hard work of raising the capital, putting together the team, the management team, the workers that are so integral to running a mining operation, and all that blocking and tackling. It's incredible what goes into actually running a mine, efficiently and effectively. But I'll say this: they've done well. Okay, they've done well, and the proof is in the pudding. So don't take my word for it. Look at their financials. Look at their presentation. Watch the CEO. He's done a lot of interviews. His name is Shane Williams. He's a good mine operator. He's Irish, and he knows what he's doing, right? And this is his sole focus. This is his commitment. And I'm not going to do the company justice because it's not just the CEO. There's another 50 people that are all key members of the team, but they've assembled a very good team there in Red Lake. And it is quote unquote high grade because the average grade that they're running through that mill is above 5 grams per ton on average. And 5 grams is, historically the threshold for quote unquote the term high grade. But now at 5x, 4x the gold price, well, maybe 3 grams or 2 grams is high grade. But they're running more than 5 grams per ton through the mill. And so do the math. What's 5 grams per ton? That's over $800 of pay dirt per ton. And generally with an underground mine and all the different operating costs, you're usually talking about $300 per ton in terms of cost. So the margin is substantial. And then factor in 800 tons per day, 30 days a month. There's a lot of math that can be done. I've done the math before. And then you subtract the corporate overhead, the G&A and all of that stuff. And not to mention that they have like $250 million of Canadian tax credits from all the losses.
Right. That's right. That was part of my calculus. Exactly.
Yeah. So there's a lot. And the share structure is a little complicated. There's a bunch of warrants out there. So you got to factor in a whole bunch of stuff. It's not a simple analysis, but my take is they've done a good job. It's working. It won't be just a straight line up. There's going to be stops and starts. And as you said, their run rate's about 45,000 ounces per year right now. But they have a 3-year plan to get that up to 100,000 ounces per year. So, any investor, and I'll just leave this here, my final comment on WRLG. Any investor that analyzes this, you need to decide for yourself, will this company manage to go from 45,000 to 100,000 in the next 3 years, right? If you don't think they're going to be able to achieve that, if you think they're going to fall short, it's only going to be 60, 65, then don't buy the stock.
Right.
But if they get to 100, stock's probably going to be worth a lot more.
Right. Exactly. So that's my understanding of management is that even though personality-wise there have been clashes with other managers, the actual running of the mine is very well done by these guys, and he's a stickler for process. And at this stage of the game, all you care about is process, in my opinion. And I think they could easily be a 5 or 10 bagger in the next 5 years. So I'm not doing this for five trading days or 5 months. I'm doing this for a 5-year play, and that's why I think I'll be able to know that in 3 years based on that's their plan. So that's the one that I bought, and I don't recommend you do anything to anyone else out there, but that's the North Star of my criteria. That fits everything. It's high grade districts. It's a production ramp optionality. They need capital. It's a mine restart. Distressed asset turnarounds. These are the things that I think are the candidates to be bought by the Newmonts. And that's why they're at the other end of my barbell. And I think I started doing this with silver, but I just couldn't find enough. I couldn't find enough for silver. And so I'm like, all right, I have to go with gold. And so West Red Lake was at the top of my list. And the other ones, should we move on to the other ones? Because I don't know anything about those, and I mean, I know enough to be dangerous. But so we let's see, there's now these other miners, just as a disclaimer, these other miners fit my loose criteria, but I haven't done the fundamentals on them. I haven't drilled down on their books. I haven't looked at anything yet. So the first one is Heliostar.
Okay, so with Heliostar, this is a company I actually wrote about them, I think all the way back in 2022, but the 2022 version of Heliostar is nothing like the 2026 version. So there was an incredible turnaround in this company that occurred in 2024 because they were able to acquire a few Mexican assets that were producers from a company that just wanted to divest some of its non-core small mines, right? And, I remember seeing the news release. It was like summer 2024. It's like, blah, blah, blah acquires La Colorado mine, San Agustin mine, total compensation, $5 million, US or something. I'm like, $5 million for 2 producing or near producing gold mines. It was like a news release I couldn't believe was real. I was like, oh, this has got to be a scam, right? And so I didn't buy the stock, but I watched it for a couple of months. And then I did an interview with the CEO. His name was Charles Funk. And he was like, no, it's real, Robert. It's real. Like trust me, we got this for a steal. And I'm like, really? And you can, like, if you search on YouTube, you can find that interview. I think it was August, September 2024, Charles Funk of Heliostar Metals, and they've executed brilliantly since then, right? So this, and like you pull up their deck, like I remember 25,000 ounces of production was like a big deal because this was a sub $100 million market cap company at that point. Well, now they're talking about growing to 500,000 ounces by 2030, which is just absolutely insane. Like that's an order of magnitude above where I pegged this company. Like I figured this is going to be a 25 to 50,000 ounce gold producer. They're going to do okay, but it's not going to be fantastic. Well, they've performed really well, and they have a really high grade project that's not in production yet, you know, and that they're working towards a feasibility study and targeting production by the end of 2028. So in that,
is that Mexico or Alaska?
They're all in Mexico. So all of the value drivers for the company today are in Mexico. They do have an Alaska asset that is high grade, but it doesn't, I don't think they have a feasibility study. They don't have permits. They don't have infrastructure. So that's probably 8 years away from anything, right? But the high grade project they have in Mexico, we're talking really high grade. We're talking about like 10 plus grams per ton, right? And so if they keep executing, this could continue to be an amazing story. But I do want to tell people to look at the chart. It's done a 6x in a couple of years, so that's nothing to sneeze at. Right. For some of my chart like technician guys, you might notice on the daily chart there's a potential head and shoulders forming, but it hasn't broken down. So the 250 on the chart in Canadian dollars, the 250 level is big support for, you know, Heliostar. So I would just you know, highlight that, caution. It's had a big move, but this management team has done a really great job.
Okay, good. Thank you. All right, next one. So my takeaway from Heliostar is much of their at least initial ramp up may have already been discounted into the market, and I need to look a little bit closer and take a look at the how much, if they've gotten ahead of themselves. Let's put it that way. All right, what about 1911 gold?
1911, I don't really have anything to add on that one.
Okay, then we'll just skip
pass on that. Yeah,
we'll just skip on it. All right, so Artemis.
So this is the Blackwater mine in BC in Western Canada. This is one of the true tier one, you know, world-class ore bodies and projects in the world today that recently got permitted, recently got built, and is now in production.
That's my criteria.
Yeah.
Right.
But look at the price tag, Vince, and look at the chart.
I know, it's not cheap. It's not cheap.
So this is in Canadian dollars, this is now a 10 billion market cap. So about 7.5 billion in our dollars. That's a very big price tag for a single asset producer.
Here's where I'm going with that. Again, that's why I bought West Red Lake and not Artemis. But I look at Artemis as like so well proven and so rich that it would not attract someone like me, but it would attract someone like a bigger miner that wanted to just buy them, because they have done all the work to the point where there's very little risk. And so maybe it's not going to be a 10 bagger, but it would be a 3 to 5 bagger, because it is that much of a quote sure thing. Famous last words. How about Snowline?
Snowline is incredible. Snowline is just one of those stories of the last 5 years. It's probably the best junior gold mining story since 2021. It's just been incredible to watch the progress, right? Like they made the discovery there in the Yukon at the Valley Deposit Rogue project in 2021. So that was the first drill hole that's, we've got gold here, right? And they've drilled it off very quickly. And you're talking about 10 million ounces of gold that starts at surface. Remember, I was talking about like the bathtub of gold. Well, that's what they have.
Right.
They literally have a bathtub of gold. 10 million ounces of gold, and the average grade is above a gram. I want to say it might even be close to 2 grams in some areas. And so for starting at surface, where it's just a big earth moving operation, that's very profitable ore. It's very profitable. But
that's your bordering on high grade because it's low grade at the surface. Right.
Exactly. Yeah, it's high grade. I would say Snowline, for an open pit deposit, we can actually call that high grade. Yeah.
On a cost basis. Yeah.
So it's great. It's great, but it's again, like Artemis,
not cheap.
It's not cheap.
Not cheap. But
it's not cheap, and it's in the Yukon. It's in an area of the Yukon where you have to take a plane to the capital of the territory. Then you have to take another plane to a smaller town in the territory. And then you need to get on a helicopter, and it's a 90-minute helicopter ride. And then you have to get in a truck. I mean, it's out there.
Right. It's out there. Right. Again, so what I'm hearing so far is Heliostar, just a quick and dirty. Heliostar is a maybe 1911 gold. We don't have anything new on. Artemis gold is a yes, but it's not cheap. Snowline Gold is a yes, but it's definitely not cheap. Now we go to Galiano gold, which isn't even in North America.
No, the Galiano is West Africa. It's Ghana. Ghana is a gold producing nation. It's one of the best 3 African nations for gold mining, but it's still West Africa, right?
No, it's Ghana. I've definitely been doing the math on jurisdiction risk over there, and they demand a percentage of the gold to be given to them, but by the same token, they support artisanal miners. I don't know, but it came up on my criteria financially, so I'm like, all right,
yeah, it's a producer. It's a small one, so it's in your wheelhouse, and they're growing. Management team looks like they know what they're doing in West Africa, but again, for me to buy that stock, I'd have to have multiple conversations with management. I'd have to dig a lot deeper. I don't know it well enough to say yay or nay.
Right, jurisdiction is definitely the thing that I'm a big fan of jurisdiction now that you've seen what we've seen overseas. So the whole mercantilism thing. First Mining Gold.
First Mining Gold. This is a funny company. They basically accumulated a bunch of projects over the last decade plus. They basically took some South American projects, some Canadian projects, some American projects. They put this in this company, and just talking about how many ounces they have in total. But mining doesn't work like that, right? Like mining is about having a camp, a geographic location with multiple assets in proximity. So you have economies of scale, and you have like a team that can work all the different assets. So having like an asset in Peru and then having an asset in Manitoba, it's like there's not really a synergy there, right? So it's kind of a weird company. But I understand why it came up on your radar, because they have a lot of ounces in the ground. But I'm not up to date with the current management team here. So again, this would be just kind of me passing and saying it's too hard. And there's going to be like if we talked about like 100 juniors, I'm probably going to say it's too hard on 80 of them. Right. And then I'm going to say yes on 5 or 6. I'm going to say no on 10 or 15. And that's just kind of how it goes. You've got to say no to a lot of stocks.
I have more to do. Right. They don't seem to have they're not concentrated. They seem to be a little bit spread out with their deposits. And so that means double the work for half the money. Yeah. And so that kind of makes me a little bit concerned. But maybe the valuation would justify it. And that's why.
Well, their model is like, let's just buy these assets that we think are good, cheap. And then during the upcycle, we're going to sell some of them for profit. Or we're going to do like an option agreement where we'll get a royalty, we'll get some cash, which is a good model, generally speaking, but they do lack focus.
Right. They do lack focus. I hear that. My final one that's gold is Aris.
Aris is a good one. Yeah, so this is so actually when we talked about this, I made my own list and I put Aris on the list. So we got a match. This is I left West Red Lake from my list because I didn't want to be like I'm biased, you know, but you came up with it, so we talked about it anyway.
Completely fair.
Yeah, you know, with Aris, I like this one a lot. It's in Colombia, it's a producer, it's a growing company. So what I really like, and I think you like too, is a sweet spot. So it's a small, 200,000 ounces a year, kind of small in the grand scheme of things, but they're growing to 300,000 to 400,000. And with Aris, I think they're going to be at 500,000 by 2027, right? So that's a lot of growth,
right?
And they have high margin mines and world-class management team. So I don't think you'll find a management team better than this one in a quote-unquote junior. But this is a junior that's going to be a mid-tier by the end of 2027, right? But that's the kind of growth profile that generates a lot of free cash flow and returns for shareholders, right? And also Frank Zustra is affiliated with this one. I'm not sure what his exact stake is, but I think it's more than 10%. So, you've got billionaire backing here, which is always nice to have.
Right. The last one, I couldn't find any silver ones that really were pure enough silver plays to do it. The last one is actually yours, and it's Highlander.
Highlander silver. So the thing with silver is, like, according to your criteria, we would be...
Hold on. I'm sorry to interrupt, but mind you, I started this looking to do it with silver, and then I couldn't find enough of them that fit the criteria. And so Highlander is the only one that I was even on my list, but I know that that's yours. So that's why I did it with gold. But anyway, again, I'm sorry.
Yeah. So we talked about Highlander. I think I mentioned it to you in a conversation in Q4 2025. And I was like, watch Highlander.
Right.
They have two world-class assets. They're silver assets. Yes, silver with gold, of course, because you never get a pure silver asset. And just the quality. So they're one project that they just acquired from Bear Creek Mining, and that transaction is closing. So now this is a much bigger company. It's basically the largest silver primary project held by a junior in the world. We're talking about like 600 million ounces of silver with a lot of gold as well, some lead and zinc as well. And what really attracts me to Highlander, the CEO is Daniel Earl. He's got a great track record in the sector. He knows how to win. He knows how to get things done in Latin America. And they have three, so this company has 3 billionaires as large shareholders. So you've got Wark, who's the billionaire that nobody knows in mining, but he has got a fantastic track record of getting large acquisitions done in his favor. You've got Eric Sprott, who needs no introduction. And then the, Lundin family, which are literally the best operators, the best builders in the business, right? So when you see those 3 in the same company, all with 10% plus stakes, and you see Daniel Earl as CEO, you see some of the other technical people that they have on the management team who definitely know what they're doing and have a track record of, discoveries. You just, even if it's 800 million, 900 million, and there's no production, you still buy it because this is going.
But is it rich pricing wise now?
It's not cheap. It's not cheap. But this is like, you go to Cartier, you're not going to get a cheap watch, but you're paying for quality.
Right. Gotcha. No, that's my rationale with the other ones we mentioned before. But you're speaking for that's my rationale for Artemis and Snowline. But this is your rationale for Highlander.
But also, Vince, like on the next sentence, let's say between their 2 flagship projects, and don't call me out, people, in the exact numbers. I'm just ballparking. Let's say 700 million ounces of silver in the ground. So let's say it's a 800 million market cap, in the U.S., but they have 700 million ounces of silver in the ground. So do the math: $1 per ounce silver in the ground, right? So is that expensive? Well, it depends upon how you can get the silver out of the ground. If you get the silver out of the ground, it's cheap.
Right. Yeah. Okay, so I think this is good for a first conversation. I appreciate your help on that. But that's it. I bought West Red Lake. I'm looking at Heliostar, 1911, Artemis, Snowline, Galiano, First Mining, Aris, and now Highlander, based on our conversation. So that's the portfolio of miners that I want to have. I want to have a portfolio of those, a bunch of those, and then on the other side, a portfolio of the Newmonts and Barracks, and maybe the twain shall meet in the middle. That's what I think is going to happen. So I think you want to have, again, just to reiterate, to be boring and reiterate it, I like mine restart stories. I like high-grade districts. I like production ramp optionality. And I'm aware that so much of management so much of that is dependent on management now that I have to do my homework on. And West Red Lake is the only one that I've done my homework on so far.
Can I leave the viewers with two more ideas that are maybe even simpler? Sort of no-brainers.
Right.
Barrick Gold. Okay.
Right.
So you're like, well, Barrick, like, of course Barrick. No, but let me give you the rationale for why Barrick could be a really good trade here, right? So remember I said at the beginning, it's basically gone sideways for the last 3 months. So you're not paying up for a higher gold price really in Barrick. Yeah, it definitely had a good 2025, but zoom out the Barrick chart 10, 15 years, go into the past, and then appreciate that even though this company may not have had the best CEO since 2019, that's changing. And what really matters is their asset portfolio. And they've got great mines in the US. They have the number one gold mining district in the US, essentially. Even though the market may punish them for their African exposure, their African mines throw off a huge amount of free cash flow and they're super profitable, right? And Newmont needs Barrick's North American assets, right? And so this is what's going on here. There's a dance going on between Newmont and Barrick. Newmont absolutely needs Barrick's North American assets. And more specifically, Newmont needs the Fourmile project, okay, in the Cortez trend. Fourmile is basically the best gold discovery, probably. I mean, you could say arguably the last 20 years, maybe longer. Let's see how big it gets. But that's high grade. That's 15, 16 grams per ton. Almost 20 million ounces of gold there at Fourmile. And
I'm sorry. Good.
I've had conversations, with industry folks at BMO last month, at PDAC. They think Fourmile itself, so this one project that's not even permitted yet, it's not built, but it's in between two operating mines,
right?
In the Cortez trend, which is great infrastructure and easy to permit for a company like Barrick or Newmont. They think it's worth $30 billion US. So this pre-production asset is so good that they think it's worth $30 billion. And Barrick's market cap, I think Friday's close was $74 billion. So take out Fourmile, $44 billion for the rest of the company. And you can do kind of a sum of the parts analysis. And basically, I'd get to 100 billion plus for the total company, right? So I think there's 35 to 40% upside from $45 a share on the NYSE in a, break the company apart into 3 parts, or, Newmont just takes all the assets in North America for some big lump sum, like 60 billion or something. And then the rest of the assets in Africa and Pakistan go to a new co that might have a 30 billion market cap or something like that. But I just see a deal getting done here. And, there's a few ways to play it, but the way I played it at the end of last year is I bought a bunch of Barrick $35 call options. Those are in the money, but just, holding on to those as deep in the money, calls with 2027 expiry. And I'll just leave it. So I'll just give Barrick, and then I'll tease we'll talk
Well,
about the second
hold
one
on.
in the next.
Let me comment on Barrick before you give me the next one. Let me comment on Barrick. Barrick is on my list on one side of the barbell. Barrick is also on my list as a catalyst, meaning if Q1 of 2026 is going to be a home run, then Barrick could be the surprise of the upside there because they're in a trading range. I mean, you could make the case that maybe they won't surprise because they are Barrick in a bad way. But Barrick is on my list. Like for me, Barrick and Newmont are the same company now. I see Barrick as disinvesting of its American work to Newmont, and I see Barrick as a foreign play. So I look at Newmont as American and Barrick as not American, and I look at Newmont as saying we want Barrick's American work, and so Barrick is becoming two different companies. It's basically a spinoff or a rump trade. But when you spin it off, you unlock the value, and so maybe Barrick's going to be a big dividend when they have their sales. I don't know, but I do think Barrick is one of those catalysts that would be that would benefit from the catalyst coming up in the Q1. Circling back to the first thing that we talked about, the Q1 concept of all-in average selling cost of over $5,000, which is what your math is right now. I think Barrick and Newmont are going to hit home runs on that. That's just my thoughts.
No,
so I'm sorry. What's your other one?
Totally agree. No, I totally agree with you. I like Barrick here for a trade between now and
right.
when they report the Q1 earnings. And
a trade.
Who knows? We might get lucky in that 2-month period where Newmont says we can't wait any longer. We got to pull the trigger here.
You're right. It's a trade with a potential upside home run. Right.
Yeah.
That's what I look at. I look at it as limited downside right now because they're in top.
What's the other one? Mid-tier EGO on the NYSE. So this is a producer that produces about 480,000 ounces of gold per year, but they just made a nice acquisition in Canada, and they're ramping up to 900,000 ounces by the end of 2027. So to double the gold production for a mid-tier in 2 years is basically unheard of. And that's, what Eldorado Gold is doing. And so EGO on the NYSE, I like this one. But again, so I just want to be clear to the viewers, we don't chase mining stocks. So we don't buy miners after they've run up 7 days in a row and they're on the cover of the Wall Street Journal. We want to buy when they're down 5 or 6 days in a row. And the sentiment on social media is really negative, and people are saying, I fucking hate miners, right? And so that's kind of like now, and maybe it's going to get worse next week. I don't know if oil keeps going up, it might get worse. The miners might get hit even more. That's when I love to buy the blood. I love to buy the hate. And so with Barrick and Eldorado, they were down last week. I would be happy if they're down again, next week, and I'll give an even better buying opportunity.
Well, I think I'm going to be acquiring over the next 30 days. So I'm not in a rush, but one side of the barbell I'm going to be rushing. The other side of the barbell I'm not. But I have 30 days to 45 days because I do want to be positioned at least half of my portfolio for the catalyst. And that's going to be the Q1 numbers. That's what I think. This is great. I appreciate this.
It's fun. So, it was fun, Vince, and we got to do it again. So let's get some feedback from the audience. Let's think about some things for a couple of weeks, and then we'll do it again.
We'll do a part 2. Absolutely. Thanks, Robert.
Cheers. Thanks. Have a great weekend.
You too.